Hey there, future investors. Welcome to our channel, where we make the world of investing accessible and exciting. Think investing is only for the rich? Here's a surprise. Did you know that as of 2021, nearly 56% of Americans own stocks? That's right. Investing is for everyone, and we're here to show you how. And here's a teaser. Stick with us till the end of this series for an exclusive investing tip that could revolutionize your approach. You won't want to miss it. So, smash that subscribe button, turn on notifications, and let's start this journey together. It's time to transform your financial dreams into reality. Welcome to the world where your money works for you. Chapter 1. Introduction to Investing. Basics and Importance. Today we're starting at square one, the very basics of investing. Why? Because everyone starts somewhere, right? You've probably heard of Warren Buffett, one of the world's greatest investors. He started young, buying his first stock at age 11. Now, I'm not saying we'll all be Buffetts, but we can learn from his journey. Investing isn't just about making money quickly. It's a way to build wealth over time. So, what's investing? Simply put, it's putting your money into something, like stocks or real estate, expecting it to grow. It's different from saving, where you stash money away. Investing involves a bit of risk, but with greater risk comes the potential for greater rewards. Think of it this way. When you save, your money sits there. Inflation can slowly eat away its value. But when you invest, your money works for you. It can grow, sometimes significantly, over time. But where to start? The key is understanding your goals. Are you saving for a dream vacation, a house, or your retirement? Your goals will shape your investment strategy. Now let's talk about different types of investments. Stocks, bonds, mutual funds, ETFs, real estate, the list goes on. Each comes with its own risks and rewards. For example, stocks can offer high returns, but can be volatile. Bonds are generally more stable, but offer lower returns. It's like a toolbox. Each tool has a purpose. You wouldn't use a hammer to screw in a nail, right? The same goes for investing. You choose the right investment for your goal. Risk is a big part of investing. Even the best investors face losses, but there are ways to manage risk. One key strategy is diversification. Don't put all your eggs in one basket. Spread your investments across different types to balance the risk. Finally, getting started. The first step is opening an investment account. There are plenty of options, from online brokerages to robo-advisors. Research. Find one that suits you, and you're ready to make your first investment. Remember, everyone's investment journey is unique. It's okay to start small and grow from there. The important thing is to start. As we explore more in the upcoming chapters, you'll gain the confidence to make informed investment decisions. So, are you ready to begin your investment journey? Stick with us and let's embark on this exciting path together. Setting your investment goals, short-term versus long-term. Now let's dive into one of the most critical steps, setting your investment goals. This isn't just about numbers, it's about what you want out of life. First things first, what are investment goals? Simply put, they're your financial targets. Whether it's buying a home, funding education, or retiring comfortably, your goals guide your investment journey. Let's take a page from the book of Elon Musk. He's not just a businessman, he's a goal setter. Musk's goals with SpaceX and Tesla were seen as wildly ambitious, but he knew exactly what he wanted to achieve. Your goals might not be launching rockets, but they're just as important for your journey. There are mainly two types of goals, short-term and long-term. Short-term goals might be saving for a vacation or a new gadget. These are typically within a 2 to 5 year range. For these, you might prefer safer investments, like bonds or high-interest savings accounts. Long-term goals, on the other hand, are your big-ticket items. Think retirement, your child's college fund, or even building generational wealth. These goals are usually more than 5 years away. Here you might lean towards investments like stocks or real estate, which have higher potential returns over time. But how do you set these goals? Start by being specific. I want to be rich is a wish, not a goal. I want to save $1 million for retirement is a goal. Next, make sure your goals are achievable. Unrealistic goals can lead to disappointment. Remember, your goals can change. Life throws curveballs. What's important today might shift tomorrow, so it's good to review and adjust your goals periodically. Balancing short-term and long-term goals can be tricky. It's like a financial juggling act. You don't want to focus so much on the future that you can't enjoy today, but you also can't ignore the future. A good strategy is to allocate your resources. A portion of your income can go towards short-term goals, while another portion goes towards long-term goals. This way, you're taking care of both immediate needs and future dreams. In the end, setting clear, realistic investment goals is the foundation of your investing journey. It gives you direction and helps you make informed decisions about where to put your money. Chapter 3. Understanding different types of investments, stocks, bonds, and more. Now, let's explore the different types of investments you can choose from. It's like a menu at a restaurant, and we're here to help you pick the best dishes. First up, stocks. Owning a stock means you own a piece of a company. Think of it as buying a slice of a big pizza. The bigger the company grows, the more your slice is worth. Did you know that if you had invested just $100 in Amazon's IPO in 1997, it would be worth over $120,000 today? That's the power of stocks. But stocks can be volatile. They're like a roller coaster. Lots of ups and downs. In 2020, during the initial COVID-19 panic, the stock market dropped by over 30%, but then recovered to new highs. So, while the potential for high returns is there, so is the risk. Next, bonds. These are like IOUs from companies or governments. You lend them money and they promise to pay you back with interest. It's a slower, steadier race with bonds. The average annual return on 10-year U.S. Treasury bonds over the past 20 years has been around 4.5%. Lower risk, but also lower returns compared to stocks. Mutual funds are another option. Think of them as a mixed bag of investments. A professional manager picks a mix of stocks, bonds, and other assets. It's a way to diversify, which means spreading your risk. Plus, you don't have to choose each investment yourself. Then there are ETFs, or exchange-traded funds. They're similar to mutual funds, but trade on stock exchanges like individual stocks. They offer the diversity of a mutual fund with the flexibility of a stock. As of 2021, there were over 7,600 ETFs worldwide, a huge increase from just 276 in 2003. Real estate is a tangible asset. It's not just about buying homes. It can also include commercial properties and real estate investment trusts, REITs. Did you know that real estate has historically had a 9.4% annual return over the past 20 years? That's a solid performance. Now, how do you pick the right investments? It's all about matching them to your goals and risk tolerance. If you're saving for a short-term goal, you might want stability, like bonds. For long-term goals, you might lean towards stocks or real estate. For higher potential returns, diversification is key. Don't put all your money in one type of investment. A mix of stocks, bonds, and real estate can balance your risk. It's like not eating just pizza every day. You need a balanced diet for good health. The investment world changes fast. Keep learning and adapting. In our next chapter, we'll talk about managing risk and diversifying your portfolio. It's all about playing it smart. Excited about the investment journey we're on? Make sure you don't miss our next chapter on risk management. Subscribe now and be the first to get these essential investing insights. Chapter 4. Risk Management and Diversification. Now let's tackle a crucial topic: risk management and diversification. It's all about smartly spreading your investments. Warren Buffett, a master in the investment world, once wisely remarked, "Diversification is a protection against ignorance." While he often advocates for a focused portfolio for those who know what they're doing, for most investors, diversification remains a key strategy to mitigate risk. Why diversify? Because markets are full of surprises. By spreading your investments across different areas, You reduce the risk of one bad performer affecting your entire portfolio. Think of it as an investment safety net. Stocks, for instance, offer high potential returns but come with high volatility. If the stock market takes a downturn, your portfolio could suffer. Including bonds, which are generally more stable, helps balance that risk. Adding real estate and commodities like gold to your portfolio can also provide a buffer, as they often react differently to market changes than stocks and bonds do. Diversification isn't just about mixing asset types, it's also geographical. Investing in international markets opens opportunities for growth in other economies. Carlos Slim, a billionaire investor, encourages this approach, saying, "Competition makes you better. Always, always makes you better, even if the competitor wins." Assessing your risk tolerance is vital. It's like knowing how much spice you can handle in your food. This tolerance depends on your financial situation, investment goals, and how comfortable you are with market fluctuations. Younger investors might lean toward riskier investments, given their longer time horizon to recover from any losses. Hedge fund manager Ray Dalio puts it well. The biggest risk of all is not taking one. As retirement approaches, however, the focus often shifts to preserving accumulated wealth, favoring more conservative investment choices. Avoiding the temptation to follow hot tips or attempting to time the market is also crucial. John Bogle, founder of Vanguard, emphasizes this, stating that predicting market movements is incredibly challenging. Regular portfolio reviews and rebalancing are important. This ensures your investment mix aligns with your risk tolerance and goals, adjusting for any market-driven changes. Chapter 5. Getting started, opening an account and making your first investment. Now, let's get to the exciting part, opening an account and making your first investment. This is where your journey truly begins. First things first, choosing the right investment account is like picking the right tool for a job. There are several types: brokerage accounts, individual retirement accounts, IRAs, and others. Each has its purpose depending on your goals. When selecting a brokerage, think about what matters to you. Fees, accessibility, customer service, and the types of investments offered are key factors. As Benjamin Graham, author of The Intelligent Investor, said, "The investor's chief problem, and even his worst enemy, is likely to be himself." So choose a platform that aligns with your needs and temperament. Now, about making that first investment. It might seem daunting, but remember, every expert was once a beginner. Start small. You don't need a lot of money to begin. Some platforms allow you to start investing with as little as $5. Diversification, as we discussed, is crucial. Don't just buy one stock or bond. Consider a mix of investments. ETFs and mutual funds can be great for beginners, as they offer built-in diversification. It's also wise to invest regularly. This could be monthly or quarterly. It's a strategy known as dollar-cost averaging, and it helps smooth out the peaks and troughs of the market. As Philip Fisher, a renowned investor and author, noted, "The stock market is filled with individuals who know the price of everything, but the value of nothing." Be patient. Investing is a long-term game. Don't get discouraged by short-term market fluctuations. As John C. Bogle once advised, time is your friend, impulse is your enemy. Research is key. Read up on the companies or funds you're interested in, but beware of information overload. As Charlie Munger, Warren Buffett's longtime business partner, says, "It's not supposed to be easy. Anyone who finds it easy is stupid." Rebalance your portfolio periodically. This means adjusting your investments to maintain your desired level of risk and diversification. Markets change, and so should your portfolio. Taxes and fees, they can eat into your returns over time. Understanding their impact is part of being a savvy investor. Finally, keep learning. The world of investing is vast and always evolving. The more you know, the better decisions you'll make. And there you have it. You're ready to make your first investment. Remember, this is just the start of your journey. The road ahead is full of opportunities and learning. And that's a wrap, folks. We've journeyed through the essentials of investing, uncovering the secrets to building wealth and achieving financial freedom. From setting goals to making your first investment, we've covered it all. Remember, the key to successful investing is patience, education, and persistence. Now, we're curious to hear about your journey. What's your biggest takeaway from this series? Are you planning your first investment, or maybe you've already taken the plunge? Drop your stories and questions in the comments below. We love hearing from you. But wait, there's more. If you found this series helpful, you'll definitely want to check out our other videos. We've got tons of content on personal finance, wealth-building strategies, and entrepreneurial insights. Trust us, you don't want to miss out. So hit that subscribe button if you haven't yet, and turn on notifications to stay updated. Your journey to financial savvy is just beginning, and we're here to guide you every step of the way. Thanks for watching, and remember, your financial future is in your hands. Let's make it a bright one.